Imagine you are 28 years old. You work in the United States, earn $52,000 a year, and finally receive the raise you have been waiting for. Your salary goes up by 10%. For the first time, you feel like you can breathe. You tell yourself that things are about to change. Maybe you can move into a better apartment. Maybe you can replace your old car. Maybe you can finally stop worrying about every unexpected bill. But now imagine something else. By the time you turn 35, your salary is higher, your apartment is nicer, your car is newer, and your monthly payments are much larger. You earn more money than ever, yet you still feel one emergency away from falling behind. Now imagine another person with the same salary, the same raise, and the same starting point. They make one different decision. They allow their lifestyle to rise slowly, while sending part of every raise somewhere their future self can still use. At 35, the difference between these two lives is not intelligence. It is not luck. It is what happened to the money between the paycheck and the end of the month. This is how one pay raise can create two completely different financial futures. Let's start at age 28. You earn $52,000 a year before taxes. That number is an illustrative example, not an average American salary. You live in a mid-sized US city. You pay rent, car insurance, a car loan, a federal student loan, and a small credit card balance. You have some savings, but not enough to feel completely safe. Your financial goal is not to become a millionaire overnight. You simply want to stop checking your bank account before every purchase. You want an emergency fund. You want to stop feeling that one unexpected medical bill or car repair could destroy the entire month. Then your employer gives you a 10% raise. Your salary rises from $52,000 to $57,200. That is an increase of $5,200 in gross annual income. On paper, it looks like a major improvement. Your friends congratulate you. Your family tells you that your hard work is finally paying off. But gross income is not the amount that reaches your checking account. Before your new salary arrives, your paycheck may include federal income tax withholding, state or local income tax, health insurance premiums, retirement contributions, and other deductions. There are also payroll taxes. According to the IRS, the employee share of Social Security tax is 6.2%, and the employee share of Medicare tax is 1.45%. So the $5,200 raise on your employment contract becomes a smaller increase in actual take-home pay. For this fictional example, let's assume the raise gives you about $300 more per month after deductions. That is an illustrative number, not a personalized tax calculation. Your actual amount would depend on your filing status, state, benefits, retirement contributions, and payroll settings. Now you have a choice. Not a dramatic choice. Not a decision that feels like it will change your entire life. Just a series of ordinary decisions. On path A, you upgrade your lifestyle. You move into a better apartment. You finance a newer car. You order food more often because your job is more demanding. You add subscriptions, upgrade your phone, and start taking more weekend trips. Each decision looks affordable on its own. The apartment is only a few $100s more. The car payment is manageable. The subscriptions are small. The meals are convenient. But together, they create a new monthly minimum. Your life now costs more before you make a single new decision. On path B, you make a different trade-off. You keep your current apartment for another year. You delay the car upgrade. You still spend some of the raise, but you automatically direct part of it toward an emergency reserve, debt reduction, or a long-term account. You do not refuse to enjoy your money. You simply prevent every extra dollar from becoming a permanent monthly obligation. At the beginning, path A looks better. The apartment is nicer. The car is newer. Your lifestyle matches your new salary. Path B may look less impressive, but the difference is not visible in the first week. It appears over time. Now look at the price environment around you. The U.S. Bureau of Labor Statistics reported that the Consumer Price Index for all urban consumers rose 3.4% over the 12 months ending in July 2026. The same release showed shelter prices up 3.2%, food prices up 3%, and energy prices up 14.7%. These are national averages. They are not a prediction of your personal budget. Some American households spend more on rent. Others spend more on gas, medical care, childcare, or insurance. The important point is that your personal cost of living can change even when your lifestyle has not. Your raise arrives once. Higher prices affect many future purchases. That is why inflation can quietly reduce the value of a pay increase. Suppose your take-home pay rises by $300 a month. During the same year, your rent increases by $180. Your car insurance rises by $45. Your grocery and household costs rise by $65. Your medical premiums and out-of-pocket costs rise by $60. That is $350 of additional monthly pressure. Your income went up. But the cost of maintaining your previous life went up even faster. You are not imagining the pressure. Your paycheck is larger, but your purchasing power may not be. This is where fixed costs become dangerous. A restaurant meal happens once. A higher rent payment happens every month. A new car payment does not care whether the month was financially difficult. A student loan payment still arrives when your grocery bill is higher. A phone contract, insurance policy, or lease can continue for years. When enough fixed costs rise at the same time, your salary has to increase just to keep you in the same place. This is why people often say, "I earn more now, but I feel poorer." They are not comparing their current income with their old income. They are comparing the money left after all commitments have been paid. That remaining money is their financial flexibility. And financial flexibility is often more important than the salary number itself. Now return to Path A. At age 29, your apartment is more comfortable, but your rent is higher. Your car is newer, but your payment and insurance are higher. Your checking account still reaches nearly zero at the end of the month. You tell yourself that the next raise will solve the problem. At age 30, you receive another salary increase. This time, your income rises by 6%. But you also decide to move again because your current apartment no longer feels good enough. The new apartment requires a larger security deposit and higher monthly rent. Your car loan still has several years remaining. Your credit card balance has not disappeared. Your income increased again, but your financial flexibility did not. This is lifestyle inflation. Lifestyle inflation does not always look like luxury. It can look like finally choosing the apartment you thought you deserved. It can look like replacing an old car after working hard. It can look like buying convenience because you are tired. None of these decisions automatically makes you irresponsible. The problem is that a temporary reward can become a permanent cost. You do not simply buy the car. You accept the payment, insurance, maintenance, and interest. You do not simply move into a better apartment. You accept a larger rent requirement every month. You do not simply order food. You create a spending habit that becomes part of your definition of normal. Now add debt. Debt means part of your current income belongs to past decisions. Your car payment belongs to a purchase you made earlier. Your student loan payment belongs to an education decision. Your credit card balance belongs to spending that already happened. The raise arrives in the present, but debt collects part of it from the future. That is why you can earn more and still have less freedom. Your income is higher, but more of that income has already been assigned. Now compare the two paths again. On path A, the extra $300 each month is absorbed by lifestyle. You do not necessarily remember where all of it went. There was no single purchase worth $3,600. Instead, there were 12 months of slightly higher rent, more driving, more delivery, more subscriptions, and more convenience. On path B, you decide to direct $250 of the monthly increase toward financial resilience. The remaining $50 is available for enjoyment. This is not a recommendation for everyone. It is an illustrative comparison. After 7 years, the $250 monthly contribution would equal $21,000 before any investment, growth, interest, fees, or taxes. After 12 years, it would equal $36,000 before any growth. Path A may also have spent $36,000. The difference is that one path consumed the money, while the other path preserved part of it as an option for the future. That money could represent an emergency reserve, debt reduction, retirement contributions, or another goal. The specific choice depends on the person and the situation. The broader principle is what matters. A raise can either become a higher standard of consumption or a higher level of financial flexibility. At age 35, the two paths may look very different. On path A, you earn more, but your monthly obligations are also larger. You may have a nicer home and newer car, but little room for a major surprise. On path B, your lifestyle may be less impressive from the outside, but you have more control over your next decision. You may have fewer high-cost debts. You may have a larger emergency reserve. You may be contributing more consistently to a 401k IRA or another long-term account. The difference is not that one person never spends money. The difference is that one person allows every raise to disappear into the cost of being normal. The other person protects part of the raise before lifestyle has a chance to absorb it. At age 40, the difference becomes even clearer. If your salary rises but your expenses rise at the same speed, you may still need the next paycheck to maintain your current life. If part of your income has been converted into savings, lower debt, or assets, you may have more choices. You may be able to change jobs, move to another city, take time to recover from an emergency, or simply sleep better, because every problem does not immediately become a financial crisis. This does not mean everyone can save the same amount. American households face different rents, healthcare costs, family responsibilities, and debt burdens. A person in New York City does not face the same housing market as someone in Ohio. A worker with employer-sponsored health insurance does not face the same costs as someone buying coverage independently. State and local taxes also vary. So the point is not to compare your life with a fictional perfect budget. The point is to identify where the raise is going. Start with 4 questions. First, how much of the raise actually reached your bank account? Compare your old and new take-home pay, not just your annual salary. Second, which unavoidable costs increased? Look at housing, transportation, food, insurance, healthcare, childcare, and debt payments. Third, which expenses increased because your income increased? Did you move? Finance a newer car? Increase your subscriptions? Spend more on convenience? Fourth, how much of the raise became something that remains? Did it become savings, lower debt, retirement contributions, or another form of financial resilience? The answers will show whether your raise improved your financial position or simply increased the size of your monthly life. A practical way to handle future raises is to decide where the money goes before it arrives. One part can improve your current life. One part can protect against emergencies. One part can reduce expensive debt. And one part can support long-term goals when appropriate. The percentages do not have to be perfect. The important thing is that the entire raise does not automatically become a new obligation. Because once a higher expense becomes normal, reducing it can feel like a pay cut. Your salary is only the amount that comes in. Your financial future is shaped by what remains after the month is over. At 28, the difference between Path A and Path B may look small. At 35, it becomes a pattern. At 40, it becomes a set of choices. The same raise can create more comfort, or it can create more flexibility. The choice is not always completely under your control, but noticing where the money goes gives you more control than simply waiting for the next raise. Your income can rise. Your expenses do not have to rise at the same speed, and a bigger paycheck only becomes real financial progress when part of it survives the month. If this changed the way you look at your next pay raise, subscribe to Jack Talks Finance for more visual explanations of how money really works.